Vancouver home prices rose in the month of March, and condos, well, they just hit a new all-time high. Yeah, you heard that right. So the March data is out. We're going to dive into all of that for you today. Plus, we're going to share some more information, some further details regarding the Renters' Bill of Rights, as those have recently come to light, as well as the recently announced federal housing program, which is designed to fund provincial housing infrastructure, and talk about if that will help create more homes. And out of the gate here, I want to share some more information regarding mortgage delinquencies. The most recent data we have nationally shows that the nation's mortgage delinquency rate sits at 0.18%. Yes, this is up from the all-time low of 0.14% we saw back in 2022, but we are still under that pre-pandemic rate of around 0.24%. But what I want to share today is how much lower this rate is in Canada compared to some of the other countries around the world. You see, the pundits here believe that the mortgage renewal wall or cliff will collapse the system and cause prices to crash. What does that mean? I don't know, 50%, let's call it. Well, if you've been following this channel for a while, you know that I stand firmly against that belief and that potential outcome. And further data has surfaced recently that I feel supports my thesis in this matter. And part of that is the arrears rate in the UK. The UK is currently sitting at 0.74%. That is 4 times higher than Canada. And it's not a spike. The UK has actually been running at about 4 to 5 times higher the rate of delinquencies than Canada, going all the way back to 2007. Almost 20 years. That's as much data as we have here. Has the UK seen prices drop over the same time period due to these high arrears rates? No, it's actually quite the opposite. You see, prices are up 58% in the UK since 2007, since that higher arrears rate that we have. And the span that they've experienced is somewhere between 0.5% to 1.2% arrears. That's a number that Canada has never, ever experienced. The highest we've ever seen is 0.63%, which happened in 1996. That is half of the worst the UK has ever seen. So let's go further. Let's explore how it looks like in the States. America, their arrears rate, they are currently sitting at 1.52%. That's 8.5 times higher than we are here in Canada. And if we go back 30 years in the States, it's always running at a higher arrears rate than we are here in Canada. America has averaged, in fact, over 1% arrears rate going back that 30 years. And what have home prices done during that same time span? 320% increase. Now, can Canada sustain a similar arrears rate to what we see in the UK or the USA? Maybe not. But what we would see is likely the government step in and create a homeowner's bill of rights, where some form of bailout may happen and keep the housing market at least stable. On top of this, the renewals are taking place about 5 years after they were started, right? Typical mortgages have about a 5-year term on them. So this renewal wall, if you will, is happening after these homeowners have had 5 years of mortgage pay down. And with these low rates that they achieved, there's a significant portion of that has gone towards principal, reducing their debt level. Plus, the average Canadian home has seen its value increase by 29% over just the last 4 years. So let's say ultimately prices stay flat for the next 1 to 2 years, hypothetically here. People will be renewing with a lot more equity in their home, thanks to that pay down plus the 29% appreciation that they've seen. And that to me equals options. The options to renew, options to leverage equity, option to sell and downsize, options to refinance and extend the amortizations. There are going to be many options that are readily available to keep homeowners solvent. And for all these reasons, I firmly believe there will be no mortgage renewal cliff. Now, some may find this thesis unpopular, but I'm definitely sticking to it. But let's hear your thoughts. I'd love to hear what you think. You know, what am I maybe missing? What information do I not have that would actually lead to a potential renewal cliff? Please share with us in the comments below. And Ryan, love to hear your thoughts as well.
Yeah, I mean, I largely agree with what you've said. The data is the data. And at the end of the day, when you look at the average Canadian home that's gone up by 29% over the last 4 years, if we, localize it to here in Vancouver, for example, and we take $1 million property over the last 4 years, that's now worth nearly 1.3 million. That's a significant amount of equity that people have as protection. And so I wanted to dive into some of your points here, mostly reinforcing it, pointing out a few things too that we should keep our eye on, but largely, the data speaks in your favor. If we look, take a quick poke at inflation, for example, I mean, it would be one of the major drivers towards this renewal cliff because of the push of interest that has happened as a result of home ownership. Most countries around the world, though, exclude interest rates from the CPI baskets to avoid that dog chasing its tail kind of scenario. So this is not the case in Canada. And if you actually take that out, we actually lower by 80 basis points. And that puts us bang on the BOC target, the rate of inflation for the Bank of Canada at 2% for 2 straight months now. With that being said, much like Dan has pointed out, and much like we've all been experiencing, we're still definitely living through one of the most significant real estate downturns in Canadian history. The thing is, though, is that the pain isn't distributed evenly. And this is a really important point. For example, the average monthly mortgage payment in Atlantic Canada, in Halifax, for example, is $2,500 a month. Contrast that to places like Vancouver, where it's nearly $5,500 a month. This means places like Vancouver, the household debt service ratio remains at effectively the highest levels since 1990. This is because there's a massive decline in mortgage principal repayments, but people are still paying their mortgage. They're paying the interest-bearing portion and a very small portion of principal, primarily because of the static payment variable rate mortgage option that was offered to Canadians over the last, 5 years in particular. But there's something you can't ignore here. And it should be noted that Canadians hold considerable assets against their debts. As of Q4, the average Canadian household had $6.55 of assets backing every $1 of debt. That's below the peak in 2021 when it was about almost $7.50, but well above where we were a decade ago. The average homeowner has about 75% equity in Q4, a full 5 points above their American counterparts. And if this seems high, it's because it is skewed. That's because nearly half of all homeowners have no mortgage debt whatsoever. So across Canada, we may see a softening in prices where supply has improved, especially if rates remain elevated, but it'll be very temporary. Mortgage delinquencies, in my mind, are likely to stall as the BOC begins its rate cutting later in the year. I think it's important to recognize and highlight that there are also maybe 2 kinds of Canadians in the housing game. There's those whose families have owned real estate for years in Canada and have seen something like 300 to 600% in the growth of their assets over the time of that ownership. We see money flowing through families to help their kids get into the market or staving off things like higher interest rate payments because families are redistributing their wealth inside of them. But then there's also the younger generation or newcomers that have arrived to Canada under the pretense that they can save a home and buy one. But the hard reality is that wages don't support those prices, especially in a place like here in Vancouver. I mean, even if we take a top earning professional here, say $150K a year or even higher, but for the sake of argument, let's just say it's $150K a year. You'll end up paying roughly $45K in income tax right off the top. That leaves you with about $105K. Assuming that person is saving to buy, it would mean they're renting, right? So say it's a 2-bedroom for $3,500 a month. It's probably more, but for the sake of argument, that's $42,000 more a year in rent. That's leaving you now with $63,000. Your groceries are going to be somewhere between $8,000 and $10,000 a year, depending on what you buy and where you buy. If you're driving to work, you're now going to pay more in terms of fuel. So call it $5K a year. And then you're left with meals, entertainment, maybe a vacation. And that brings you down to something like $30,000 or $20,000 a year that you're left to save. And that's as a top earning 1% person in our Vancouver economy. When you consider median household incomes, it's not even close to this. So you don't have, when we see things like the median, incomes not able to service, the price of real estate, especially in a place like Vancouver, you got to remember it's not honestly those people that are buying real estate in Vancouver. And I'm not talking about whether this is right or wrong. This is just the way it is and what we typically see. And so this is causing just a much bigger wealth divide. And I think there's pundits that would love to see a mortgage renewal cliff take place so that so many of these hardworking Canadians who don't have a chance at buying real estate could get it. But in our major metropolises where supply and inventory is super tight and prices have gone up dramatically, especially not just in the last 5 years, but over the last 30 years, it's just creating a bigger wealth divide. And so, yeah, I don't think we're going to see a huge amount of mortgage delinquencies because there's money in the system. And we've got data that proves that.
Yeah, exactly. And I don't think people actually want there to be a mortgage deferral cliff. It's just that they're looking for any potential reason or catalyst that will actually bring reasonably priced homes to market. That's it. You know what I mean? At the end of the day, if there was some other thing that actually could bring that 4 million needed homes to the marketplace, as CMHC has stated, overnight, well, they would probably champion that idea much more so than seeing other people suffer.
Totally. I completely agree. Speaking to people who have been suffering, let's get into the Renters' Bill of Rights here because further to last week's announcement, there's a bit more detail that have come to light. It's a very interesting sort of position, but there's some good, and there's some not so good or maybe just useless. But anyhow, here's what the amendments include. So allowing for more flexibility and addressing cases where there is a problematic tenancy and prescribing more clear guidelines for ending that tenancy with justified cause. Increasing the amount of notice a landlord must give a tenant when ending a tenancy for personal occupancy. Increasing the amount of time a landlord must occupy a rental unit after a tenancy for personal occupancy. This goes from 6 to 12 months. And increasing the amount of time a tenant has to dispute a notice to end a tenancy from 15 to 30 days. There's also they're prohibiting evictions for personal use in purpose-built rental buildings with 5 or more units, and prohibiting evictions for the conversion of rental units to specific non-residential units. There's a few other ones too, but that being said, this is really I feel this is more political than it is maybe a representation of the actual rental market. That's not to say the rental market's perfect by any means, but the vast majority of landlords and the vast majority of renters have quite a symbiotic relationship. So this, I think, overall is just going to, further push what would be landlords who could be more housing providers in the marketplace out of it, who won't maybe bring a basement suite to the marketplace because they're losing more and more rights of their own home. The government seems to be making the idea of being a rental provider less attractive, ultimately, And the other side of this is the government can't build enough rental properties to sustain the level of demand. So they have to play ball with landlords. But this isn't really helping. And a lot of what we've seen, at least from the federal side too, that's come out, I don't know how, it's just really an application, I think, for votes to the millennials and the Gen Zs. Why are we promoting having a safe rental environment, which I guess we need to have, but at the expense of wealth creation so that you can be less of a burden on the system? It's look over here instead of over here, in my opinion.
Yeah, what it kind of feels like right now is, unquestionably, renters should have rights, just as landlords should have rights. And what it seems like we're seeing right now is a tendency that's leaning more and more in favor of the tenants. And that is not necessarily the best way to create sort of an open and fair marketplace for the rental market. Because if less and less rental housing providers are less and less incentivized and almost punished, if you will, in some eyes, they're just not going to bring product to market. And that is going to further exacerbate the housing problem. So don't favor one side more than the other. Try to just make it fair, I think, is all we're saying. And again, if you lean way too hard to one side, yes, you're either going to hurt the tenants or hurt the landlords. Whereas, as Ryan mentioned, you can quite easily create a symbiotic relationship. So I think we're just asking for fairness in that marketplace. Let's move on now to talk about the Trudeau's new infrastructure bill. So he just came out and announced $6 billion with the federal housing program to fund provincial level housing infrastructure, which of course includes your water, wastewater, and waste infrastructure. So the government is going to require that municipalities adopt fourplexes. Great, that's already kind of happening. I mean, but now it looks like it's going to happen nationally, and require a commitment to implement a 3-year freeze on increasing development charges. I'm going to clap to that because that's one of the first things I've heard in a while that I think may actually help here. Now, if implemented correctly, this may address some of the issues currently that hinders new supply, new housing coming to market. Because right now, the cost of paying for infrastructure largely falls on the developer. And those costs are and can be substantial. You know, you're talking well into the 6 figures for just a duplex, for example. Definitely for fourplex and more multifamily doors. And often these costs, they're going to push a project into the realm of unprofitability and therefore ending the idea of the project right then and there. Believe me, if you could somehow remove the infrastructure cost or the city fees and taxation altogether, there would be a lot more people building today, for sure. So I believe this plan actually will help bring homes to market. This is decent. You know, it's a good idea. Don't lay the blame of infrastructure on the developer. I'm sure it's a polarizing concept, but here it's happening either way. Let's also keep in mind, too, that while it's going to be welcome news to a lot of builders, if you basically just create a $6 billion plan with the swipe of a pen, it's going to be a little bit inflationary as well. You're pumping more money into basically a bloated system, and we'll ultimately likely see those costs increase, right? Maybe the infrastructure, staffing, the employees, etc. They're going to see a lot more work coming their way, and hey, what does that mean? Pay bumps and so on and so forth. But I am pro this swipe of the pen myself.
Yeah, I just wonder if it'll actually take place. Number one. Number two, I hope that we don't see, taxes come up somewhere else. So it's sort of, taking taxes or freezing, if you will, fees over here only to raise them in a different area to offset them, kind of like the carbon tax. But anyhow, we're not here to discuss that. Dan, let's get into the stats.
Let's do it. Okay, you made it this far in the podcast. Let's give you what you want. This is time for the March data. And we always start out with the health of the market being, of course, how many homes actually sold last month. That number came in at 2,415 homes. And how does that compare? Well, that is down from last year, almost 5%, but it's up 16% month over month. Not a huge surprise that it jumped. Obviously, March is typically busier than February. Sales volumes, though, they're up 3 months in a row. Again, fairly typical this time of year. And sales volumes are sitting around the highest they have been dating back to August of last year. Pull back even farther, though. Let's look at the big picture, compare it to the 10-year average. It is slow. Average sales are about 31% below that 10-year average. And why is that? Well, of course, when you have less to choose from, less people are going to buy. And just for reference, if we go back to, let's say, the same month, March, 5 years ago, 2019, there were 40% more homes to choose from.
Wow. Yeah, taking into account, too, the cost of mortgages and people are sitting on the sidelines. We look at new listings here, 5,002. That's a 16% year over year increase, a 10% increase month over month, but still 9.5% below the 10-year average. That being said, this is welcome news.
Absolutely it is. Inventory still the story right now. At the end of the month, it washed out at 9,950 homes active on the marketplace. Yet another month of sub 10,000 inventory. It is up, thankfully, year over year, about 16% and 5% increase month over month. But this is where it's starting to get a little crazy, is that we're actually 6% above that 10-year average. So right now, it's low inventory, and yet we're higher than the average from the past 10 years. And that's largely based on, of course, 2016 through 2018 had incredibly low inventory, as was basically 2021 until today. So average it all out, and we're actually sitting above that. So this sub 10K inventory we've been talking about for a couple of years now is, well, it's the norm. There you go. Good luck. It is freaking tight out there. We had a video, I don't know where it was, 6 months ago or something like that, where we discussed the concept of low inventory forever here in GVRD. And a couple of years in now, this is kind of becoming true. It is not an attractive environment for buyers, I'm afraid. You are seeing very few homes within your price band that you probably like. And the ones you do like are probably going into multiples, and you're getting into a bidding war, which again isn't a very friendly place to be. So even with interest rates increasing for the past couple of years here, we have not seen that flood of inventory come to market. In fact, it's still doing the opposite, right? People are essentially holding on to their homes and holding on to those rates and just not being able likely to afford what else is out there. Question is though, is this trend finally starting to shift? Because March 2024, last month, does have the highest amount of inventory compared to the last 2 years. So maybe it is starting to trend in the right direction.
It's too bad there's not a stat for the quality of homes, though, because I think that would speak to an interesting dynamic as well. Or homes that need, tremendous amount of repair or, something to that effect, because I think that's largely what is new to market here. We're seeing more and more of that kind of product. I mean, Dan, last week alone, I was in 3 offer scenarios where all of them were in multiple offers, and the average age of the home was more than 25 to 50 years, right? So it's either has to be renovated, needs work, but we're still seeing people, lots of people, and in many instances, those were also subject-free offers that we were making. So interesting time, depending on where you're looking and the kind of asset class you're after. Speaking to this, the sales to active ratio is up 2% month over month. This is the 4th monthly increase in a row, now sitting at 24%. It's the 2nd month in a seller's market here. So one more month here, and we've got a full-on trend in a seller's market, which kind of blows my mind considering everything we've just spoken about. When we dive into asset classes here, it's 18% for detached. That's up 3%, 31% for townhomes. That's like getting in fistfights every time you're trying to buy one of those. That hasn't moved. And 26% for apartments, down a nominal 1% here. So pretty interesting place to be when you're looking at the behavior of the market.
Now let's get into price, because as we mentioned off the very top here, prices rose again. So we've got 2 months now where HPI has increased. It went up 1.1% last month, and that follows a 1.9% increase the month before. So we're actually up 3% in just 2 months. And keep in mind, 3% should be a normal year, not a normal couple of months here. I mean, you could imagine if 3% over 2 months was annualized. I mean, that's an 18% growth. But we're not there, right? HPI is up year over year, definitely not 18%. We're about 4.5% higher than we were this time last year. But we're 2 years into this rate hiking cycle, and the resilience of the Vancouver market is showing itself once again. So what do these prices actually look like? Well, the average home here for HPI price, $1,196,800. It went up about $13,500 just last month, and $35,000 in the last 2 months. So this jump now puts the HPI about 5.5% below the all-time high, which we saw back in 2022. But check this out, because condo prices, according to the HPI, just hit an all-time high. You heard that right. Condos are sitting $1,100 higher than the previous all-time high record set back in May of 2022. That's when people were buying with mortgages that were, in the high 1s or even the low 2% range. And here we are, new mortgages in the 5s, and condos are priced higher than ever. Well, why is that? Especially when we know people's buying power is down about 30%. Well, I think one reason this is happening, of course, is because the people who want to buy, who want to get into the market to see it going up and up and up over time, well, maybe they've now been priced out of that townhome, and so they're buying what they can, which is a condo. So you're seeing a larger buyer pool for that type of home. And so, like Ryan just demonstrated, you're going out there and you're offering on 3 different condos in a week, and they're all going into multiples and selling for over asking price. So more demand, of course, on this limited supply tends to push prices up. But let's explore more. Maybe you don't like or trust the HPI. Well, let's see what median is doing. Median went up $40,000 last month and is now sitting $100 below its all-time high. $100. Okay. February 2022 is when we last saw median prices this high, when we also saw 0.25 interest rates. Now we have 5% interest rates, and median price is basically just touching the all-time high. What's it going to do next month? Are we going to see a record median next month? Maybe. Well, let's look at average. Average also went up $38,500 last month. It's sitting at $1.318 million. This is the third monthly increase for average price, now up 78 grand in just those last 3 months. Average price sits about 2% below that all-time high. And again, at this point, you have to really ask yourself, like, what can it possibly take to significantly lower home prices in GVRD other than supply? It's clearly not adding the 5 taxes that we've seen over the last 8 years. That hasn't done anything. So I don't know. Again, it's supply.
And even still, tough question to have to ask, but are we even going to ever see that? Are we going to see prices actually significantly lower, even with a significant amount of supply? It would all have to happen at once in order for that to take place. And that's also not going to happen. I'm just of the mind that we're in a place now in Vancouver where the wealth gap and the wealth divide is between those who are in the property game, and then there's those who service the debt on it. It's just an unfortunate kind of scary reality. That's kind of where we're at. And when you consider the fact too that 50% of these homeowners do not have a mortgage, why would they sell low? They don't have to. They've held it for the last 25, 30 years. They'll continue to do so. So I don't see a huge change coming in price points to the downside. Let's look at days on market. They're at 11. That's down 3. This is the lowest since July of 2023.
Yep, it's moving fast again. You know, another example here to give you guys an anecdotal story. There was a nice detached that hit the market yesterday in Coquitlam. Went out this morning. Oh, they weren't holding offers. So I'm like, let's go. Buyers in 9:30 a.m. today. We're out in Coquitlam. And the listing agent was almost surprised that they have 6 showings booked for today. And it's just, this is how quick the market's moving, especially if you decide to not hold offers for a detached home, it's going to get interest. Mm-hmm. But let's chat a little bit here, Ryan, about what things are going to look like for the rest of this spring market, right? We're in April. It's full on spring market here. And my opinion here is that we're largely going to see what we saw not only last year at this time, but last month for a much more recent reference here. It is tight. Inventory is low, right? So what does that mean? It means the good ones go fast. Ryan's experienced it. I've experienced it. Our whole team's experienced it, right? You're going into multiples for anything that's decent. And it's, I mean, gosh, prices are going up, right? And we've discussed this, I think, a lot about how and why they're going up. I don't think we'll get into it more in this episode, but essentially the people who can't afford are, and the vast majority of people that are buying the larger ticket items are just moving up in the marketplace because they can't, right? They're going from 1.2 to 1.8. They're not coming out of the gate and buying a $1.8 million home as a first-time home buyer, for example. But as a buyer, it's kind of like what we've talked about in any uptrending market. Move fast and be prepared. And as a seller, well, price strategically, and you're going to get a lot of interest. There's no question about it here. So things are moving, and it's still tight, but people are kind of lining up. I've got more buyers than product, I'll tell you that much.
Yeah, I would say, if you are a seller, you do have to be sharp with your pricing. Yeah, prices are going up, but they're not going up like they were during COVID. So, don't have that mentality. Don't price too far ahead. You will sit. We will see that. Inventory is also climbing. With that being said, though, if you're priced well and you're a decent property, yeah, it's flying. I mean, I have a number of listings, or we have a number of listings coming to market here shortly, a lot of which I've been leaking to social media and been doing showings in these properties prior to even taking them to the MLS. So, the interest level, the amount of eyeballs on the market is significant. And I expect that's going to increase as we get later into the spring. As the closer we get to June or potentially July, whenever this expected interest rate cut's going to take place, I think you're going to see more and more activity in the marketplace spur up. More and more agents reaching out for off-market properties, trying to make things come together for their clients in what is a really tight inventory market.
There you have it. Thanks as always for tuning in. Welcome to April. We are in our spring market, and we'll be happily updating you every single week on how things are moving, what's important in real estate, and everything that you need to know. We will see you again here next week. Bye.